APRA has changed the rules for banks, but what does that mean for borrowers? So on the 1st of February 2026, APRA has enforced some guidelines that the bank must follow when it comes to debt to income ratio. So essentially what this means is that if your income is, let's call it $100,000, your maximum borrowing capacity is approximately $600,000. That means that your debt to income ratio is around 6 times. Now obviously income $200,000, debt to income ratio 6 times is borrowing capacity of about 1.2. Now that's not to say that you'd be approved for that. Other things are taken in consideration like living expenses. There's also things like if you've got car loans, credit cards, they will also get taken in consideration and may reduce your borrowing capacity. So what exactly has changed for banks? So any new loans written, the bank must not exceed 20% of the new loans written to be what is classified as a high DTI or debt to income ratio at 6 times. Now, the issue is that whilst this might be okay for owner occupiers, it definitely restricts investors because the debt to income ratio at 6 times definitely caps your borrowing capacity, especially in your personal name. Now, my recommendation is that you get yourself a good broker to really have a look at your personal circumstances to make sure that you can maximize your borrowing capacity, especially if you're a savvy investor that wants to grow. Now, the other thing to take in consideration is this is not all lenders. I guess it's really all the banks, some of the major banks, some of the second tier banks, but it's not all lenders. So your non-bank lenders or funds are not restricted by these guidelines. So again, reach out to your broker to make sure that they understand your borrowing capacity to maximize what you can do for your next purchase.